And look, that portfolio your financial advisor told you was safe, it belongs in the trash. For the last 40 years, they've been selling you a safety net that looks suspiciously like a hammock. They call it the 60-40 rule. You put 60% of your money in stocks for growth. You put 40% of your money in bonds for safety. And the theory here is, which they have repeated so many times it has become a religious chant, is that when stocks go down, bonds go up. They're supposed to balance each other out. It is supposed to be the golden retriever of investment strategies. Loyal, safe, good with kids. But in 2022, that golden retriever bit the mailman, dug up the rose bushes, and burned down the house. For the first time in decades, stocks and bonds crashed at the exact same time. If you were holding a 60-40 portfolio, you didn't just lose money, you lost your safety mechanism. You walked onto a battlefield wearing a bulletproof vest made of tissue paper because a guy in a suit told you it was diversified. And now, the biggest institutions on the planet, BlackRock, Goldman Sachs, the people who actually run the casino, are quietly admitting that the old playbook is dead. They are saying we have entered a new regime, which is corporate speak for good luck, you're on your own. In this video, I'm going to show you exactly why the 60-40 rule died, and I'm going to explain the math trick the government uses to hide the inflation that killed it. And then I'm going to show you the specific institutional strategy that the ultra-wealthy are using to replace it. Because while you are losing 20% of your retirement, the smartest money in the world was doing something completely different. So why did the safety net fail? Why did the thing that worked for your parents turn into a financial suicide pact for you? It's because for 40 years, from 1980 to 2020, we lived in a fantasy world called the Great Moderation. You see, inflation was low, interest rates were falling, and when interest rates fall, bond prices go up. It's simple math. It created a 40-year bull market for bonds that acted like a giant fluffy airbag for the stock market. But the airbag wasn't real. It was inflated by the Federal Reserve, and now the Fed has punctured it. We are in a new era of structural inflation and volatile rates. You see, when inflation rises, the Fed raises rates. When rates go up, bonds crash. But higher rates also hurt stock valuations. So instead of balancing each other out, they have linked arms and jumped off a cliff together. It creates a correlation of 1. Everything falls at once. And here's the conspiracy. Your financial advisor knows this. The bank knows this. But they keep selling you the 60-40 portfolio because it is easy for them to manage. It fits in their software. It generates their fees. They're selling you a map for a terrain that no longer exists. They're selling you snow tires for a car that is driving through a volcano. Let's look at why this is happening. Let's look at the engine of the destruction, because it all comes down to our favorite word, inflation. But not the inflation they tell you about on the news. I'm talking about the real inflation. The government tells you inflation is cooling. They tell you, hey, it's 3%. And then lunchtime hits. You get a little hungry and you go into the Subway sandwich spot looking for that $5 footlong because it's so delicious and find out that doesn't exist anymore. In fact, that $5 footlong doesn't get you 6 inches. And you think, am I crazy or are they lying? They're lying. They use statistical tricks to hide the damage. My favorite one is called Hedonic Adjustment. This is a real thing. Let's say a new car costs $5,000 more than it did last year. Normal math says that is inflation. Government math says, well, hold on. This new car has a backup camera and a better stereo. The quality improved. So the price didn't really go up, the value did. So they adjust the price down in the CPI report. They tell you there was no inflation on the car. Well, try telling that to your bank account. Try paying for the car with hedonic quality points. You can't. You pay with cash. And this matters because bonds hate inflation. So if you lend the government money at 4% interest, that's a bond, but real inflation is 7%, you are guaranteed to lose purchasing power. You are locking in a loss. A bond used to be a risk-free return. Now, it is a return-free risk. You are taking all the risk of the government defaulting or printing the dollar to zero and getting paid less than the cost of a sandwich in return. And this is exactly why I talk about the leaking battery. If your safe money is in bonds earning 4% and inflation is really 7%, your battery is draining. You are bleeding purchasing power every single day you hold that asset. So if you want to see exactly how fast your battery is leaking, and more importantly, the specific asset swaps you need to make to plug the hole, I broke it all down in my Inflation Defense Manual. It's a tactical guide on how to move from paper promises to hard assets. It's free, it's essential, and I made it easy by uploading it for you at inflationdefense.com. And look, I know this all feels overwhelming. You did what you were told. You saved, you diversified, you bought the index funds, and now you look at your 401k and you realize it has basically been flat for 2 years when you adjust for the cost of living. You feel like you're running on a treadmill that is tilted uphill. You are not crazy. The system changed the rules in the middle of the game. They stopped rewarding savers and started punishing them. If you stay in the 60-40 model, you are essentially betting that the last 40 years will happen again. You are betting that the government will pay off its debt, inflation will vanish, and the Fed is going to save you. That is not a retirement plan. That is a wish list written to Santa Claus by a delusional economist. So if you can't trust bonds and stocks are a casino, what do? Well, you do what Yale does. You do what Harvard does. You look at the endowment model. You see, these are funds that have to protect wealth for centuries. They can't afford to play games. And if you look at their portfolios, they don't use the 60-40 rule. In fact, the Yale Endowment holds less than 10% of its money in traditional bonds. So where is the money? It's in private alternatives. It's in real assets. They moved billions into things that are anti-fragile, things that actually benefit when the dollar gets weaker. But you aren't Yale. You don't have $40 billion. I don't know, maybe you do. But how do you replicate this strategy on a much smaller scale? Well, you need a two-pronged defense. Prong one is direct ownership. This is your foundation. You need assets that you control. You need assets that give you the tax shield. This is why I preach turnkey rental properties. You see, when you own the rental directly, you get the depreciation, the phantom loss to wipe out your tax bill. You get the control, and you get the inflation infantry, the tenants paying off your debt. This is your base. This is how you stop the bleeding. But there is a limit. I mean, maybe you don't want to own 50 houses. I understand. Maybe you don't want to manage the manager. And maybe you just want the yield and the scale without the tenants and the toilets. Well, that brings us to prong two, the war chest. This is where you act like the bank, not the janitor. This is where you pool your capital with a professional operator to take down a massive asset, like a $50 million apartment complex or a commercial facility. This is what we call a syndication, or a private fund. And in this model, you don't fix the toilet. You don't deal with the eviction. You just provide the capital. You trade control for scale. The operator does the work. They force the appreciation. They distribute the cash flow to you. This is exactly what the endowments do. They don't mow the lawns of their apartment buildings. They write checks to operators who know what they're doing. And right now, less than 1% of retail investors, like you and me, have money in these private alternatives. Institutions, they're at 20 to 30%. But the gap is closing. The retail wave is coming. And you want to be positioned before everyone else figures out that the stock market is a trap. Here's the reality. The 60-40 rule is dead because the math doesn't work anymore, because the old rules are gone. You can cling to the 60-40 split and hope the storm passes, or you can stop trying to beat the casino and start owning the table. And that is the mindset shift that you need to make. You need to stop thinking like a landlord hoping for a rent check and start thinking like the bank demanding a mortgage payment. You need to move from equity to debt. And that's why I pulled this video out here for you to watch next. It breaks down exactly how to structure that type of income, how to secure a predictable 8 to 10% yield without fixing a toilet, without chasing tenants, and without putting your capital at risk in a stock market that is rigged against you, because it most definitely is. So click that and I'll see you inside.